Okay, good morning, everybody. Thanks for coming out. For those who came out, welcome online here. We got Jimmy Le-Tang, accountant, who's going to do a nice little presentation for us. He specializes in PRECs and accounting and so on. And he's going to answer some of your questions that you might have. So make sure you type them in there. Angel will watch for you guys online to answer any questions there. He's done me a favor. I asked him to talk a little bit about rental properties and a few of the tax incentives there, because a lot of people are doing the refinancing, and that brings Paul over here, our mortgage broker guy, in doing the refinancing and then buying a revenue property. So a good little market there, niche market there. So we'll be talking about that. Before we do get going though, I just want to make sure that everybody knows here that this is for a PDP credit for those of you. So we'll get one PDP credit for this professional development course credit. So no problem there. A little bit on the market update. I'm going to be quick on that one. We've kind of done that a couple of times, a couple of things going forward. The market, there's such low inventory, it's keeping the prices steady. So things aren't moving drastically one way or another, but there's no inventory out there. And in fact, it's causing quite a demand because of the low inventory. And in fact, we're starting to see multiple offers. So in some areas on a well-priced property that's in a desirable area, you're going to see some multiple offers. And that being said, tomorrow we're going to offer another PDP credit course on multiple offers. So that's 10 o'clock tomorrow. It's going to be on Zoom. If you do need PDP credits, or if you're a new realtor and you've never experienced multiple offers, please plan to attend that one, because that's going to be important. You guys are going to get yourself caught in the ins and outs and what I can't do, what I can't do. And any of you who have been in multiple offers, Sonny can tell you it's something else. And you've got to have your head on a swivel here, watching what's going on and making sure everything is happening for your clients in the right way. And there's a strategy. Mike Cook has been in that a lot of times, multiple offers. And you got to really watch your way around that one and know what the rules are, so you can do a better job for your clients. So that's what we're going to talk about. What the rules are with regards to multiple offers, what a listing agent can do and can't do. And you may be on the other end of that, where you're a listing agent, if you're lucky enough to have a listing, and you're going to get multiple offers coming in. So you're going to need to know what the rules are relative to that as well, so you don't get yourself in hot water. A couple of questions that I got this week, just to kind of keep everybody up to speed. The rescission period with an offer that has subjects. Well, can you remove this? Can you, if you have an offer that has subjects on it for 5 days, and our rescission period is 3 days, should you remove even if your guy decides not to buy it, should you walk away within the 3 days? Are you liable to pay the rescission? And the technical answer is no, but in practicality, there's a lot of misinformation out there about that. So I would wait until after the 3 days before you backed out, because a lot of people are under understanding that if you back out in 3 days, no matter what, they're going to get their 0.25%. So don't go there. Just avoid that totally. Wait till after the 3 day rescission period ends, and then send them an addendum saying we're not removing subjects. And that's fair enough. So just watch out for that one there. You don't want to get caught up in a he said, she said kind of thing. And then you got the managing brokers calling each other, and your clients are upset at you because they think they should or they shouldn't. So a lot of it is dealing with your client's expectations. So in those cases, if you're the realtor putting the offer in, wait till after the rescission period, and then tell them you're not going to do it. You can give them a heads up on the phone. We're likely not going to remove subjects so they can start marketing again. But the formal one should go, after that period. And I think the other realtors, like the top realtors, will know that. You're just doing everybody a good favor. We had a client back when it was one of our realtors provided a deposit with the subject offer. Normally, what we do is we provide the deposit upon subject removal, upon final subject removal. And I usually put on that one within 1 business day of final subject removal. And the reason I don't put 24 hours is because a lot of times, and I see this all the time as a managing broker, you guys put within 24 hours and you do it on a Friday and you forget it's a Friday. Now your client has to go to the bank on a Saturday to try and get their money out, and they can't because the bank's closed for whatever reason. I've had that happen with Van City. They're closed Mondays, by the way. Got caught on that one. So I always put within 1 business day. So if it's a long weekend or whatever, they really don't have to get the money until the following business day. So that alleviates a little bit of thing. But in this case here, they put the it was a kind of a commercial deal. They put the deposit down with the initial offer. They put subject to an inspection. They did the inspection didn't go well, they backed out of the deal. When they backed out of the deal, they wanted their money back, but because when we get a deposit, when you get a deposit check, your obligation is to give it to us right away. Our obligation is to not answer our phones. And let me just, sorry about that, guys. I meant to put that on hold, but I didn't. So our obligation is put in our trust accounts right away. Once it goes in the trust account, it gets locked in. The only way you can get that money out on a deal out of a trust account is if the deal closes. If the deal collapses, but you need both signatures, the seller and the buyer's signature to release it. If you haven't given it, you don't need that release because we don't have it. But if you've given a deposit up before you've removed subjects, then we need the seller's signature and the buyer's signature to release it, or it's by court order. In this case here, whatever happened, I don't know. But the buyer and the seller had a fight, and the seller wouldn't sign the release. So now we're stuck with this. We can't get the money released. So now we have to go to a lawyer. And the fact of the matter is that they put subject to inspection on there, and they actually did an inspection in this case. So that's good. And a lot of times people back out, oh, we don't like the place. Well, you put subject to inspection, you didn't do an inspection. You're not, doing due diligence and doing your maximum effort to make this thing happen. In this case, they did the inspection, but it didn't go well. There was some alterations that weren't done with permits or whatever it might be. So they backed out. So they have every right to get their money back. And I'm kind of choked about that. But we have to go through the rigmarole now of me calling the managing broker. And ultimately, it's probably if the seller is not going to cooperate with us, we're going to have to go to Ken Pass or one of our lawyers and say, okay, let's get our money back, because we have every right to get it back. It's just bull on that one there. So careful about that, guys. Don't put the deposit up before your subjects are removed and you're ready to go with that. And that's another whole nother story there. I got questions about FinTrack, third party. Somebody buying it for their sister who is a foreign buyer. That's a tricky one. We absolutely have to disclose that on FinTrack. They're buying for a third party. But then you get into that other one about the $10,000 fine. Now, as a managing broker, I think a little weird. I think of all of the things that could go wrong and what can happen. But if we help a foreign buyer buy a place when there's a ban on it, we could get fined 10 grand. But in this case here, the way I see that is that we're not helping a foreign buyer. We're helping a Canadian person buy for a foreign buyer, but we're disclosing that they're buying for a third party. So we should be okay on that one there. But keep it, ask those questions. If they're buying for a third party or anything like that, we got to fill in that FinTrack correctly. And what I asked him to do is this is, we'll get a FinTrack on both of them. They're sisters. Get a FinTrack on both and we'll report it. It's, for a third party, and let the government deal with that. That's not us. We're here to sell real estate, and we're selling it. We're helping a Canadian buy real estate. You ask for somebody else, but hey, that's not our choice or decision. We've disclosed everything that we need to disclose as far as I'm concerned, and that's where we're going to stand with that one. So careful on your FinTrack, guys. Fill those out carefully. The FinTrack people are out there. They're doing a lot of investigations and things like that, and they're asking a lot of questions. So I'm going to be very vigilant on your FinTracks. I'm going to Daisy. As a matter of fact, if you're missing the actual what they do, and we had one where it was what do you do? They were an accountant, and we wanted to get what kind of an accountant, and there's all kinds of them out there. So just a little bit more than that. Retired isn't good enough. Retired fireman, retired teacher, things like that. Businessman. Well, we had another one that came in as a businessman. I said, well, who is this guy? I don't know who it was. I looked him up online. I just did a quick Google search. Whole companies were out there listed by him. And I put that all on there that, the guy runs this company, that company, blah, blah, blah. Or I asked the realtor to put on there. I don't fill in your forms for you. So just a simple search on Google showed what kind of businesses the guys are running. Instead of just putting businessmen, they were able to put a little bit more detail on these FinTrack forms because they're coming down on everybody. I'm sure Paul is going to get that in the mortgage business as well. They're really looking at the paperwork going forward. The final one that I have before Jimmy comes on is disclosure of latent material defects. We had another one where apparently it was a grow up. We don't know that the owner told the realtor, our realtor, that no, it was illegal, grow up, everything was fine. Well, what the hell's illegal, grow up in a house? No. But she has seen the paperwork and everything's okay. So, we're supposed to take her word on that. And I said, did you see the paperwork? It's nothing. Well, do you know there was any paperwork at all? I doubt there was, because for one thing, I think for environmental reasons, mold and all that other stuff, you can't really put it in a residential property because it doesn't have the ventilation, so on and so forth. The big deal now is not the legality of it. Pot's legal, but the problem is the problems that it causes in humidity and your electrical and all that other stuff, and it could leave spores and mold and all that stuff. So it has to be remediated, and you have to have certificates and all that stuff. So my advice to them was make sure you get, and apparently they had all of these, and they had the air quality check, and they had an inspector go in there for the wiring and everything was fine. I said, well, make sure you document that. But our obligation now is to disclose what we know, and that's a latent material defect. And there's a form for that. It says fill out the form, put it online, and have the latent material defect form out there, but have the explanation in there. It wasn't really a serious go up. We had grown a couple of plants, but it's all been remediated. We've done an inspection. The air is good and everything's there. So that when you do get the objection, yeah, it was, but we're fine. And the biggest objection there is going to be the banks, right? They're going to have a problem with that. But if you put the explanation there and you clearly put it that it's been proven that it's not a problem anymore, you're going to probably have a good chance of getting it put through the bank or whatever. And if it's not one bank, another one will do it, because the banks are doing these things now. It's not the end of the world like it used to be in the old days. They wouldn't touch it with a 10-foot pole. I don't know, Paul, do you have anything on those, or do you have any recently?
Still a number of lenders that don't care to get into that, but there are more and more that will entertain former remediated grow ups, as long as the men with white suits went in and the seller did what they could and spent the money for them to go in and make sure it wasn't going to be an ongoing problem with the purchaser. So they're always looking, lenders are always looking out for the buyer to protect them.
Yeah, and that's good.
Yeah.
So deal with these problems head on, deal with the objections up front, put them in front of you so that nobody finds that after the fact, because it's going to be 10 times worse if they find out you didn't disclose it. And as well as you're going to be in trouble as a realtor not disclosing,
I had a listing with that, right? Remediated grow up.
Yeah, I'm talking about you. No, I'm kidding. Yeah. So, there's an example of this exact example in the book about latent material defects. And if the owner tells the realtor to not disclose that, we have to walk away from the deal. And the thing is with that, I said, you got to explain it to them that it doesn't matter if it's you or any other realtor. We all have to do the same disclosure, or they're not doing their job. And you really want a realtor like that? Well, maybe some people do. I don't know, but you want an upstanding, honest realtor, and that's what we are. And that's what I said. Nobody else is going to be able to sell that. And by the way, it's a really tight market right now. Today's the day to sell it because we got no inventory. So you're getting multiples. They're going to make these exceptions to these properties. So I think you got the listing and they disclosed. They put the latent material defect online. So make sure you're looking out for that, and you're disclosing what you need to disclose. That's it for me. I'm going to introduce you to Jimmy here. I've known Jimmy for a number of years here, and everybody that I talked to that have worked with him have given him great reviews, and he's a good guy. Takes good care of your business. So Jimmy, come on up, and thanks.
Thank you very much. Make sure this thing's working the way that we anticipate. Sorry, guys. Oh, I think it's coming on now.
Yeah.
Your thing doesn't seem to want to play nice here.
Just give us one moment, guys. Do you have any questions so far?
We had it working earlier.
We did.
Did everybody get a form here?
No output here.
How are you? Okay, good. All right. These will be sent out to you guys as well. Don't worry about it. We'll have a little package coming out for you guys on the internet.
Just from earlier.
It says no signal.
Yeah, it's just no signal now.
Jiggle everything.
Jiggle everything.
Jiggle, jiggle, jiggle.
Jiggle, jiggle, jiggle.
Could be on the other end there.
We put it on like properly though.
Yeah. Well, it seems to be okay now. Sort of. Let's just try closing that. Closing that. What if it's on multiple screens? You don't really see it. Well, that's not even my desktop, is it?
That's your desktop.
That is my desktop.
Yeah, you're the only one there. Sorry, guys, for having technical difficulties. Give us a minute here. You might, yeah, you might be there. There you
Oh,
go.
there we
You
go.
got-
Oh,
So
okay,
just
I'm
put,
gonna duplicate that.
yeah.
Yeah, I see what the
You
issue
gotta
is.
Extend.
We're seeing it.
Okay, there we go. Yeah, it was coming up as an extended.
I'm gonna keep monitoring the screen just in case there's any questions that comes up.
Oh, thank you. Yeah, I really appreciate that. Okay, we should be good to go now.
Perfect. We're seeing it now.
And
Yeah, I don't.
play.
That's the thing, I don't get the details.
There.
There we go.
Can
Okay.
everyone see this properly? There. Perfect.
Okay, we're good to go.
Okay.
Okay, Doug, we're good to go now.
All right, yeah, all right.
Amazing.
Thanks, Jimmy. Okay, we're on.
Yeah, we're good. All right. Good morning, everybody. Thank you very much for having me here today. I really appreciate the invitation. And Doug, thank you very much for having me over here. Sorry, gentlemen, I'm going to have my back facing to you a little bit. I apologize for that. I'm delighted to be here to talk to you today about wealth preservation through tax minimization. That's kind of my area of specialty, is making sure that you pay as minimum amount of taxes as possible based on whatever objectives that you might have. Okay. Before we get too far into the presentation, I want to make sure that whatever I talk about today is intended to be of a generic nature, right? So please don't go acting on anything that we talk about today without either seeing your own accountant first, or come see me, or we can chat on the phone, text message, email, whatever. Just don't go doing anything without talking to somebody first, okay? A little bit about me. I know Doug had a great introduction for me. Thank you very much. I do specialize in working with real estate agents. That's kind of my area of specialty, and primarily touching on to real estate taxes. So GST, income taxes, property transfer taxes, speculation tax. Now we've got the new underutilized housing tax on the federal side. So there's a lot of things that touches onto real estate, and that's my area of interest and specialty. So as a result of that area of interest, my clients tend to be realtors. Your clients could also be my clients. And I do these seminars to help get out the information to kind of alleviate and counter some of the misinformation that you might have. And just to make sure that we get the right information out there so that people are doing things based on the right and correct information, and timely information too, right? So today what I want to talk about is tax deductions and things that you can look at on your personal tax return. And also, to a certain extent, it also applies to personal real estate corporations too. So if you're a PREC, a lot of the stuff will also apply. And Doug also asked me to talk about rental properties as well. So if I forget about that towards the end, make sure somebody, remind me. I'm sure Doug will remind me as well too. Fantastic. So we are into tax season right now. So I figured a discussion about deductible expenses it would be really handy for you at this time of the year. So I'll talk to you about referral fees, auto expenses, meals and entertainment, your home office expenses. Those tend to be the larger expense categories for realtors. And if you are not a PREC, we'll also talk about why you might want to convert to a PREC, because ultimately that is the best tax planning tool available to you. Okay. And then at the end, we'll have some questions and wrap up. Okay, so referral fees. When I talk about referral fees, I'm talking specifically about fees that you pay to persons who are not a party to the transaction. So neither the buyer nor the seller. This is somebody who might have referred you, a buyer or a seller, and therefore you're paying them outside of the transaction for the benefit of them referring that business to you. Okay. The referral fees are tax deductible. Okay, so that's one of the biggest questions I always have is, are they tax deductible? They definitely are. And I do recommend that you obtain their full name, their address, and here's the real kicker, their social insurance number. Okay, and you get this information before you pay them. Okay, because a tax deduction for you as a business is taxable income for somebody else. That's what the CRA looks at it. Okay, so if you don't have their name, their address, and most importantly, their social insurance number, you're going to find it very difficult to file a T4A slip. And if you can't file a T4A slip because you're missing that information, in the worst case scenario, the Canada Revenue Agency will deem that to be then a non-deductible expense. Okay, so filing that T4A slip kind of closes that loop, right? Taxable deduction for somebody else, for you, means taxable income for somebody else, your recipient. Okay, so do get that information before you pay the money to your referral source. Okay, I made a note here that all recipients of referral fees who are paid cumulatively more than $500 in a year are required to have a T4A slip. Okay, so a T4A slip, in case you don't know, it's a slip that you would issue to people who you pay who are not your employees. So a T4 slip would be for your employees. A T4A slip would be all other persons who are not your employees. Okay, so referral fees would fall into that. This is very different from rebates that you pay to your client who is a party to the transaction, because for them, any kickbacks of your commissions that you pay to them would be factored into their adjusted cost base for capital gains or capital loss purposes. So it's reported differently. Okay, but referral fees, you need to ensure that you file a T4A slip. Okay. All right, let's talk about auto expenses. Oh, and I should also point out too that if anybody has any questions, here in the room, you're more than welcome to interrupt me. I'd be happy to answer those questions for you. If you're in the virtual Zoom meeting, you can put into the chat group. I'll circle back to your questions a little bit later on, and I think Angel's helping me out with monitoring the chat as well too. Okay. In terms of auto expenses, you have two primary methods of deducting your auto expenses. The first one is to pool all of your expenses and then deduct just the business portion of your auto expenses. The second method uses a mileage reimbursement rate, and you multiply that rate times the amount of kilometers that you've driven in a calendar year. And if you're a PREC, then in your fiscal year. Okay. I do want to emphasize that both methods do require a mileage log, and that's a really big point of objection that I get from a lot of my clients is, how do you manage a mileage log? How detailed does it need to be? And it's just outright inconvenient to manage one. But I can tell you that the Canada Revenue Agency knows there are lots of apps available out there today that will track your mileage for you. You simply need to let the app know whether it's a business kilometer or a personal kilometer. Okay, so gone are the days where we could kind of say, well, it was too inconvenient to manage one and make one up kind of after the fact. The CRA does expect a mileage log that looks like a mileage log, the date of your trip, where you're going, your starting point, your ending point, total kilometers for that particular trip. Okay, so if you don't already keep a mileage log, I do recommend that you keep one, because the Canada Revenue Agency, they're desperate for money, right? I mean, they are the tax collector for the federal government. And as you know, over the past several years, federal government's been dishing out a bunch of money. Now they're strapped for cash, so they're looking for ways to get that money back, and the CRA is the ultimate tax collector. So there are a lot of audit activities going on for a variety of different reasons. A lot of those audit activities touch onto real estate. So do be aware that if you don't have a mileage log, worst case scenario is you're going to end up having all of your automobile expenses denied, which could be substantial, right? Most of my realtor clients, auto expenses are probably in the $15,000, $20,000 range. It's a 5-digit number. And if you are a sole proprietorship and your marginal tax rate is 40% and you lose a $20,000 deduction, when you multiply that by 40%, that's $8,000, right? So, that's a huge chunk of change, right? So don't get caught up by not maintaining a mileage log. Get yourself an app. There's lots of them available out there. It's really easy to do. Okay. Now, in terms of the different methods, We talked earlier about the pooling method. So in the pooling method, you simply gather up all your expenses, gas, repairs, maintenance, insurance, interest, and other costs related to the ownership or the operation of a vehicle. And then you simply multiply that by the ratio of your business kilometers in the numerator and your total kilometers as the denominator. Okay, I've got the mileage reimbursement rate at the very bottom there. So if you want to use the mileage reimbursement method, you don't have to pool all your expenses. In fact, you don't even care what your expenses are, because the mileage reimbursement method is intended to capture all of your ownership costs, like interest on a loan, for example, and it's also intended to capture your operating costs. So if you use the mileage reimbursement method, the only thing you need to track are the kilometers that you drive for business purposes. You don't even need to track your personal use kilometers. You only care about your business use kilometers. Okay? And it's 68 cents per kilometer in the first 5,000 kilometers, and then 62 cents per kilometer thereafter. Okay.
Jimmy,
Yeah.
Does that include the maintenance on the car? You get some big changes, you get some big expenses.
Yeah, so it includes oil changes, repairs and maintenance, whatever other scheduled maintenance you need to do if you're using the mileage reimbursement method. If you're using the pooling method, you would just add all of that together and pool and then multiply
How
that by the
accurate is
ratio.
that to really capture costs, the mileage or reimbursement?
Oh, it's not very accurate at all, actually. So I do have a tip for you, going back to my previous slide. If you have a low-cost vehicle to maintain, then you're often better off using the mileage reimbursement method, because you'll probably end up with a better deduction, especially if you drive a lot, which most of my realtor clients do. You drive a lot of kilometers, but you have a low-cost maintenance vehicle. Mileage reimbursement method is definitely the better route to go. Okay. Yes, sir.
Is that the next slide you had, 0.68 and 0.22, is that sort of a?
Yes. Yeah, that's right.
CRA?
That's the CRA prescribed rate. Yeah, that's right. And then if you have a vehicle that is fairly expensive to maintain and you drive fewer kilometers, then the pooling method would result in a better deduction for you.
You calculate both, just pick one that's.
You tend to have to, if there's anything that the Canada Revenue Agency does not like, is inconsistency, right? So if you choose one method one particular year, the implied expectation is that you will continue with that method to ensure there's some consistency there. Okay.
Jimmy, is there a way where if you drove 100,000 miles and you said you use 60% business, 40% personal, you could do the 60-40?
Well, if you're, so 60-40, that's fine. You can do 60-40 as long as you've got a mileage log, right? And if you're using the pooling method, that's where that 60% really comes into play, right? But if you're using the mileage reimbursement method, then you're simply just taking the 60% of your kilometers that are business use kilometers and multiply that by the mileage reimbursement rate here. Yeah. Okay.
No, I use the first, I use the pooling method, but I was wondering if the other one is better than the first.
Yeah, and you are allowed to change your method when there is a change in your business. So some realtors move from one market area to another market area. That might result in a change in their overall business. So then at that point, you can reevaluate what would be a better method to deduct for you. Okay, I also get a lot of questions about whether it's better to lease or finance a vehicle. From a tax perspective, leasing or financing a vehicle substantially results in the same tax deduction, just a different calculation to get there. Okay, so if you're going to ask me about whether it's better off to lease or finance a vehicle, I often come back to you with the question about a cash flow basis, right? Are you, do you want a lower monthly payment, or are you okay with a higher monthly payment in exchange for knowing that the vehicle is yours, right? Because in a lease, we all know the vehicle is not yours, so you're just renting it. Okay, so therefore your monthly payments are less. Now, from a tax perspective, there are limits on what you can deduct as deductible auto expenses. So if you have a leased vehicle, your maximum vehicle price is $36,000. I know, let it sink in. That doesn't get you very much. Okay. From the CRA's perspective and the federal government's perspective is that they don't want to subsidize your choice of whatever you choose to drive. And if it's more than $36,000, you are capped in terms of your deductible expenses on a vehicle based on $36,000. Anything above that would be effectively non-deductible. Okay. So if you have a lease vehicle, your maximum monthly lease payment that is deductible would be $950 per month. But if your vehicle price is more than $36,000, then yeah, monthly limit will be ground down based on a formula that's set by the CRA. Okay, so in other words, the more that your vehicle purchase price exceeds $36,000, the lower your monthly limit of $950 becomes. So lower and lower and lower. Okay. If you pay a down payment on that lease, then the down payment also reduces that monthly limit as well too, because that's part of your vehicle price. And then you also have to amortize that lease, that down payment over the life of the lease. So if you're to put down, let's say, I don't know, $24,000 on a 2-year lease, that's your down payment. You can't deduct all that $24,000 in the first year. You have to spread that out over the next 2 years, which is the term of your lease. Okay. GST on your lease payments are also limited to that first $950 as well per month. So if you have a lease payment that is $2,000 a month, you can only take the GST on the first $950, and the GST beyond that would be non-refundable for you as well. Okay. Okay. So that's lease vehicles. With respect to purchase vehicles, maximum purchase price again is $36,000. And a passenger vehicle costing more than $36,000 would have to be added to a certain specific class on your tax return called a class 10.1 vehicle. And purchase price above $36,000 is non-deductible, and any GST paid on your purchase price above $36,000 is also non-refundable. Now, not reflected here on my slide is for the present year, and at least for the next couple of years, the Canada Revenue Agency is allowing for an immediate expensing of the entire tax deductible portion of the vehicle's acquisition costs. So that $36,000, you can deduct that entire amount in the first year that you acquire the vehicle. So that is the current promotion right now, if you want to call it that, from the CRA, where anything that you acquire that is capital equipment for your business, that is fully tax deductible in the year of acquisition. You don't have to spread it out in terms of what is called capital cost allowance, and usually for vehicles it's 30% per year. So the CRA right now is allowing for a 100% tax deduction right off the bat in the same year that you acquired the vehicle. Okay.
Wow, that's great.
Yeah, that's really good. So if you have leasehold improvements, I don't know, like if some of you maintain your own office outside of here and you have to do leasehold improvements to make it more like an office, that is entirely tax deductible in the first year, right? So usually you have to spread that out over the term of your lease, right? So if you have clients who are running a business and maybe you help them get a strata office or a retail space, all of those leasehold improvements are tax deductible in the year of expenditure, right? No longer do you have to spread it out. Okay. The backstory to that, of course, is the U.S. had allowed for 100% deduction right off the bat. So Canada didn't want to lose out on larger corporations building warehouses, building offices, losing that business to the U.S. So they allowed for something very similar. Okay. Any questions so far? No, we're good. Yes. Pardon me? Okay, well then that would have been 2 years ago. Yeah, so we're talking about vehicles that you acquire now for that 100% deduction, right? If you had bought it 2 years ago, it would already be on your capital cost allowance schedule. You're already deducting it based on your 30% per year. Okay. Any other questions before I move on? Okay, thank you. So in terms of personal tax implications, I want to point out that if you are a PREC and you have a corporately owned vehicle or a corporately leased vehicle, there is something called a taxable benefit where you have to calculate what is the prescribed portion of your vehicle use that is personal, and that gets charged back to you as a shareholder debit. Okay, accounting terms is shareholder debit. Your accountant will know what I'm talking about. But the point is, if you have a corporately owned or leased vehicle, there is a taxable benefit portion that gets charged back to you, representing all the times that you take the vehicle for grocery shopping or whatever else. Yes, sir, you have a question?
For the previous slide, is it still the same as the maximum
Oh, that's a very good question. Electric vehicles have a separate asset class called Class 54, and a Class 54 asset has different limits. Okay, and I believe the present limit right now is $55,000 as your maximum purchase price on what they call zero emissions vehicles. There are certain conditions though for a Class 54 asset. So the vehicle itself must not have been eligible for received a federal rebate or a provincial rebate. Okay, and the vehicle, I believe it needs to be a new vehicle as well. So pre-owned vehicles, I don't think qualifies. I might have to look that up actually, right? And then the other part too is, yeah, it must be either a full battery vehicle or a plug-in hybrid. Okay, let's move on to meals and entertainment. So with respect to meals and entertainment, only 50% of your meals and entertainment are deductible for income tax purposes. Okay, for your record keeping, you would still report 100% of your expense to your accountant. That's really important because the deduction for 50% occurs on your tax return. Okay, so if you're a PREC, it's really important that you let your accountant know the full 100%. They'll adjust for the 50% on the corporate tax return for your PREC. The GST that you pay on your meals and entertainment is also limited to the same 50% restriction as well. So you don't get a full GST input tax credit on your meals and expenditures and entertainment expenditures. There are certain expenses that we all consider to be meals and entertainment that the CRA has a specific rule that says no tax deduction at all whatsoever. So any fees, dues that are related to golf club dues, social club dues, gym club fees and memberships, initiation fees, season tickets to sports teams like the Canucks, Whitecaps, whatever, those are 100% non-deductible. If you get single game tickets, those are caught under the regular 50% deductible rule. Okay? And if you're kind of curious why the CRA would have a specific rule for season tickets, the CRA considers purchasing season tickets to be part of a membership as opposed to a one-off game, and therefore caught under the 100% non-deductible rule. A lot of my clients also tend to buy gift cards to give to clients. Yes, those are tax deductible. However, if you're buying gift cards and they are to locations that are meals and entertainment, BC liquor store, restaurants, you know, whatever sporting event, and you're giving those away, those gift cards would also be subject to the 50% non-deductible rule because they fall under meals and entertainment. So rather than giving away gift cards to restaurants and whatever, I would suggest you consider maybe Home Depot, Winners, you know, I mean, your realtors and your clients are buying and selling real estate. I'm sure they would appreciate a gift card to Home Depot too. I mean, they're probably going to do something at Home Depot.
To the mall.
Yeah. So like if you do like a mall gift certificate, they could use that anywhere, right? Or even like a Visa gift card, they can use that anywhere. But if you're giving a gift card that says whatever restaurant name and it's clearly meals and entertainment, that falls under meals and entertainment. Okay. So if you're giving away gift cards, I would suggest you give something that is not to a meals and entertainment type establishment.
What gift boxes that are not food and wine?
Oh, that'd be fine. Yeah, but gift boxes that are food and wine would be caught under that 50% rule as well.
How do you prove, you know, which gift boxes you give it?
Oh,
If you
wow.
get to the audit, that would be different.
I've never had to respond to that audit, but if I was an auditor, maybe I might ask you to give me a list of the names of the people that you gave your gift cards and your gift boxes to. I don't think I'd ever call your client. No, I don't think I'd take it that far.
You can
Like,
keep a record of.
But I don't know, man. Auditors are a
Keep a
different kind
record
of
of
breed
what
of
the
people.
gift box was.
Yeah.
Keep a record of it.
Yeah, I mean, if you really want to be diligent, I made a note here that wherever possible, try to write the name and a phone number of a person with whom you are going out with, or maybe you're giving something away. Just write, you know, their name on the back of it. Right? I seriously doubt an auditor would ever call. Right? But if you show that step that I normally write names of people who I would give it to, then the auditor feels probably the guy probably didn't give it away. Right?
Jimmy,
Yes.
so the receipts eventually turn white.
Yeah.
So if you have that photo, I guess, of it to prove. Like, I have a lot of blank, clear.
Great looking receipts, right? Those are the best kinds because then you can fill it in with whatever you want. Right? There's at least for my clients, so we do a lot of bookkeeping engagements as well too. And for our realtor clients, what we do is we get them to either scan and email us their receipts, or they can upload it directly to a cloud service that we use. And that cloud service will retain the digital image of whatever you're taking a picture of. It'll publish right over to an accounting software that we use to track your expenses as well too. So at any time in the future, you wanted to call up that expense, the receipt that you gave us would be attached to that transaction in your accounting records. So it'll be really easy to pull up again, okay? So in terms of keeping your receipts, you don't have to keep your physical receipt, okay? But you do need to keep a digital representation of it, okay? And I want to be very clear that the CRA expects something like a picture or a scanned image. What they don't want is for you to type in a Word document the details of that receipt, because that's not the receipt. That's just you typing in whatever it is, right? So a picture, scanned PDF file, whatever, that would work well. Anybody else have questions about that?
Just a time-consuming process to scan all those receipts and send it over to you guys. It's just to give you a box of receipts.
We can do that too. Yeah, we can do that
You're
too.
gonna charge for a small fee.
Absolutely, for a small fee. Small fee. But no, realistically is yeah, to the extent that you don't want to do that task, we're ready to do it for you, because ultimately it's going to fall to somebody, right? And we'd be happy to do it for you. But there's lots of apps out there nowadays, and it's really as simple as just, you know, snap, snap, snap when you are wherever you are, and you can discard that receipt too, right? I try to make a habit of scanning my own receipts probably on a weekly basis. Basically, whenever my wallet gets too thick, right? As soon as it gets too thick of receipts, I'm like, I gotta be ditched.
Even every night you get home, you start to take out a receipt, scan them, and put it in the box.
Absolutely, yeah. So, you know, the as the saying goes, there's an app for that. So there's definitely an app for that, and it helps to make things a lot more convenient for you as well. Okay, there are certain exceptions to the clawback rules. So if you're throwing a Christmas party or a holiday party and all of your team is invited, then those expenses are 100% deductible, not subject to the 50% deduction limit. Okay? And if you are throwing on a special event for where the benefactor is a charity, those would be 100% deductible as well too. So not subject to your 50% deduction limit.
Jimmy,
Yes.
The red envelopes, Chinese New Year,
Yeah.
that's all 100%.
Yeah, absolutely. The only trouble with that though is that they're all cash, right? So I mean, if you have some sort of a record, and only if you're asked, right, then you would say, yeah, I gave a red envelope to this person. Right. Okay, let's talk about home office expenses. I know everybody here has a home office. And the question I often get is, well, how do you know how much of a home office expense that you could deduct? My recommendation is to use something similar to that pooling method we talked about for auto expenses. So you would do the same for your home office expense. So you gather all of your expenses related to the property itself, interest on the mortgage, property taxes, utilities, insurance, other things related to the property, not repairs and maintenance though, and there's a reason for that. And then you multiply your pooled expenses by the ratio that you use your home for a business use. Now, that portion of your home should be some discrete space, like a den or a second bedroom, okay? It should not be just some open corner of your living room, or it should not be your dining room, which also you use for a personal use portion as well too, okay? I also get a lot of questions about, you know, if you are utilizing your home as a home office or a portion of your home, does that jeopardize your capital gains exemption when you go to sell your home, okay? And the short answer to that is no, it does not, because the portion of your home that you're using for business purposes is not a huge portion of your home. Your home is still primarily used as your home. So the CRA will not consider your use as a home office to be a partial change in use, which would trigger some sort of a prorated amount of your capital gains exemption, okay? So I fully expect that somebody's home office is at best 15%-ish of their total square footage, right? So like if you had 1,000 square foot, I don't know, condo, townhouse, and you have a spare bedroom that's 12 by 12 feet, that's 144 over, 1,000. So that's your 15%, right? I'm not expecting you to have your entire basement suite be your home office, which then might get you into a 30% ratio or a 40% ratio. The higher that business use portion becomes, the more likely it is that you'll have a hard time defending the fact that your home is still your home. Okay.
We have a question
Yeah.
here. What are some of the apps that you recommend in sorting receipts?
Oh, okay. So the one that we use is called DEXT, D-E-X-T. Yes, D-E-X-T, all caps. It's called DEXT because it stands for digital extraction, right? So that particular app, you snap a photo of your receipt, goes onto the cloud. From there, you can classify your expenses. You can utilize rules to classify your expenses that it kind of does it for you. There's a lot of artificial intelligence built into that. So the more you use that particular app, the more it will know that the next time you go to Cactus Club, it's a meals and entertainment. And then you set rules with your sales taxes too. The next time you go to Canadian Tire, it's maybe repairs and maintenance, whatever the case may be. And that particular cloud-based software also piggybacks onto QuickBooks Online, where you can then track the rest of your expenses and your revenues as well. Okay. Okay, any questions about home office expenses? All right, let's talk about saving for taxes. Now, especially at this time of the year, your tax bill is coming due pretty soon, April 30th to be exact, okay? Your GST return is due June 15th. But if you owe GST, you're supposed to pay your GST bill by March 31st, so the end of this month. And if you owe income taxes, you're supposed to pay by April 30th, despite being allowed to file on June 15th, okay? What I strongly recommend is when you are receiving your commission checks, set aside some money right off the bat so that you have some money set aside for your income taxes. I'm only suggesting you set aside 5%, earmark it for GST, and you set aside another 25% earmark it for income taxes. Doesn't matter if you're a PREC or a non-PREC realtor, this ratio works really, really well. But to be honest with you, you don't have to utilize this 30% that I'm suggesting. Any number that is above zero is great, okay? Any number above zero is great. The reality is many of my clients don't set aside those funds. So when it comes time to file their corporate taxes, personal taxes, GST, all those taxes represents a significant outflow for you, right? And it becomes effectively a bill. And I'm trying to move my clients away from that mentality. It's not a bill because, first of all, that money wasn't even yours to start with, right? That GST that you've been collecting from your clients on your commissions and the GST that you pay on your expenses, none of that was your money in the first place. You are an agent for the Canada Revenue Agency in their tax collection activity. So that wasn't even your money. Technically speaking, you should set that money aside from the very, very beginning. And one of the common triggers for an audit is when you don't pay on time. That is a very common trigger for an audit. From the CRA's perspective, they're saying that money wasn't even your money to start with. When the bill came due to pay it, you should have already been able to pay it. You didn't pay it. You spent our money. Why did you spend our money? Maybe we should go digging around to see what other money that you spent that didn't belong to you too, right? So that is a very common trigger for an audit. The income taxes, well, that is less of a trigger if you don't pay your income taxes on time, but the GST is very important. And for those of you who might have employees on your team and you have payroll remittances, so CPP, EI, income tax deductions that you're collecting from your employee, those are effectively trust funds, just like GST. GST is trust funds, right? And those payroll remittances, those are not your money either. Don't pay your payroll remittances late. That is also another trigger for an audit, okay? So again, these are just suggestions in terms of how much money you set aside, but the reality is if you set aside something more than zero, you're gonna be in a great shape, okay?
Hey, Jimmy, on that
Yeah.
one there, right? On my account at CIBC, I can pay it directly. So when I get money, I'll just pay it. I pay it right away. I'm not so sophisticated that I can collect interest on 5%. I just pay it
Yeah.
I'm bad as everybody else. I'll spend the money if it's in my account.
I totally understand what you're saying. Yeah. So even, if you send the money right away, that's even better. That's next level, right? But heck, if you just had a separate savings account that is outside of your regular day-to-day account, that's also a really good practice too, because out of sight is out of mind, right? Okay. And then the last little bit before we talk about rental properties and whatnot is the ultimate tax minimization tool is your PREC. Okay, so the PREC has been around for a long time. I think it's been around since like 2009, right? And yet I still come across and meet very successful realtors who are not PRECs. And I don't really quite understand what the holdup is, but there are lots of reasons why you might want to become a PREC. Number one, there's a lot of flexibility in terms of how you decide to compensate yourself. There might be income splitting opportunities for you where you can split income with your spouse or your adult children. At the very minimum, there's probably a tax deferral where the taxes that you would have otherwise paid as a sole proprietorship, you can carve out the PREC portion and pay that down the road, right? If you don't spend all the money that you're earning, there's a significant deferral benefit available to you there. Okay. And then finally, to a lesser extent, of course, there's asset protection. I mean, as realtors, you guys are professionals, you have errors and omissions insurance. I don't expect anybody here is going to get themselves into so much trouble that their insurance isn't going to cover whatever mistake that you make. But, in the unfortunate circumstance that you make some egregious mistake and you do lose that lawsuit, as a PREC, you are operating through a corporate entity. So you have that corporate veil that protects your personal assets from liability. Okay. So let's put some of these figures, benefits into figures here. So on the left pie chart, that's somebody who is earning $200,000 of net business income after expenses. They'd be paying $7,000 in CPP and $65,000 in personal income taxes, leaving them with $128,000 after tax personal money. They do whatever they want with that money. Okay. If you are a PREC, and let's say you wanted to, there's you and your spouse, you pay $89,000 dividends to both of you. You're going to end up paying corporate taxes of $22,000, personal taxes of $25,000 between the two of you, leaving you with $153,000 net after tax savings. So that's really $25,000 difference in taxes. That's a tax savings, permanent savings. Okay. If you had a deferral benefit, so let's say, for example, you don't spend all of your money. You've got money left over that you leave in your PREC, and the amount of money that you want to take out for your own use is $89,000. So same idea, you have $200,000 of net business income, you pay corporate taxes of $22,000, you take out a dividend for yourself of $89,000, that's what you use for your personal expenses. You pay personal taxes of $13,000 on the $89,000 dividend. The rest of the money stays in your PREC. That's $165,000. So the deferral there is $35,000 deferral. And I want to key in on the fact that I'm using the word deferral, meaning you will pay taxes down the road, right? So down the road could be when you retire. But every year, you rinse and repeat this cycle. Every year, you're deferring taxes every single year until you get to retirement. And then at that time, you bleed out your company later on, okay? But the point is, you're always better off paying less taxes now, because of time value of money as well, okay? So I'm going to leave you with some ideas in terms of when you should PREC, because that's often a question I get as well too. And the common question I get is, well, how much gross commission income do I need before I would consider becoming a PREC? So I'm going to encourage you to think not in terms of gross commission income, but think in terms of net after business expenses, after personal expenses, net savings. That's really what you want to think about, okay? But here are some indicators for maybe a PREC is a good idea for you. So if your gross commission income is fairly high, there's probably a good chance you're going to benefit from a PREC. Unless, of course, you spend all that money too. I can't help you there if that's you, okay? So if you're a high income earner, that definitely indicates that you probably could save some money or defer some taxes by being a PREC. If you have income splitting opportunities, so maybe you have a spouse that doesn't work a full-time job, Maybe you have some adult children that also don't work a full-time job either. You can get them to work with you in your realtor business, and you can split income to them. There's income splitting opportunities that will enable you to save some income taxes. And the last little bit here is that if you don't live a very expensive lifestyle, you're pretty frugal, for example, then your expenses are not going to be very much. And if your expenses are not going to be very much, you probably have a pretty healthy savings at the end of the year. And if you have a healthy savings and you're not a prec, then just know that whatever your savings are, you're paying full tax rates on that savings. So if you are a prec, you can leave your net savings in the prec and just pay the 11% corporate tax rate instead of the 40 or 45, or the highest marginal tax rate in BC is 53.5%, right? So you can see that the higher your income, the greater the difference between the prec tax rate of 11% and whatever your personal tax rate might be, okay?
Just a question.
Yeah.
You say you're a high income earner. The question I get is how much? Like what is there a number there, like 150?
Oh, it's
100,
relative to everybody, relative to everybody. But
I guess it goes with the last question, is how frugal you
yeah, I can't really answer that question, right? But if you really want a number, I mean, I would imagine, I really don't want to say in terms of how much top line revenue, but if at the end of the year, you've got $40,000 or more left in your bank account for that year, that's your net savings, right? So $40,000, if you are a marginal tax rate of 40%, where, well, let's say it's 41, because 41 minus 11 is a lot easier to. So that's the 30% difference in your tax rate between the prec and your personal taxes, right? So 30%, you multiply that by $40,000, that's a $12,000 deferral, right? Now, of course, you got to minus your incremental fees for being a prec, like your licensing fees, you got to double that, right? Your accountant's fees, your legal fees. But if you were to say, let's budget $5,000 a year for those incremental fees, well, 5,000 out of the 12 that you just deferred, you're still ahead by $7,000, right? So that number just gets bigger the larger your net savings is at the end of the year. Okay. Now, I do have some prec structures here in terms of what your prec should probably look like. For brevity of time, I'm probably going to skip over these and talk about rental properties. I often get questions about, should I incorporate and throw all of my rental properties into a corporate structure? The answer is always not that simple, right? Usually I look at it from what's the tax benefit for you? Because I'm an accountant, so I always think of things in terms of tax benefits. Well, if you've got some sort of property that has an inherent risk with owning that property, and I can't really think of one unless there's maybe an environmental issue or something, then really, I don't know, I don't really view properties as being inherently risky, right? From a tax perspective, if you own property in your personal name, you pay income taxes on your net rental income. You add that net rental income to your personal income taxes for the year, and you pay your tax rates based on your total income pool. Your marginal tax rate might be 40%, might be 53.5%. If you own property corporately and the property is generating passive investment income, the tax rates for private corporations earning passive investment income is 50.67% at the corporate level. It is extraordinarily high, right? The Canada Revenue Agency does not want people with the financial wherewithal to invest in real estate assets to squirrel away their money in private corporations. So you don't get that 11% tax rate when you have passive investment assets owned in a private corporation. You pay a separate tax rate called the aggregate investment income tax rate. So only at private corporations level is there a distinction between the different types of income, passive income versus active income. As a realtor, you guys would be active income. If you own real estate properties earning rental income, that's passive income. In a corporation, those two different types of income are taxed differently. On your personal tax return, there's no distinction between the two types of income. Everything just gets added to your income pool. So my general answer to should I own rental properties in a corporate name, if we're talking purely tax benefits, probably not. Okay. However, if you are a prec and you're earning all of your income in your prec, and now you got all this money inside your prec and you don't know what to do with it, well, you can't invest in stocks, bonds, mutual funds through your prec. You can't buy real estate properties through your prec unless you're using it for your office, right? The Real Estate Act guidelines says that your primary income earning source in a prec must be through the provision of real estate services. So you can't earn rental income through your prec. You need to have an outlet for how you get that money out. So I guess going back to this slide here, if you have a holding corporation who's a shareholder of your prec, you can pay dividends to your holding corporation, and those dividends will be tax-free to your holdco. Okay. Now the money is outside of your prec, where you can't really do anything with it. Money is now in a holdco. Your holdco is not a prec. It is not governed by the Real Estate Services Act in terms of what it could do to earn income. So therefore, it's free to do whatever it wants to do. You can go ahead and turn around and buy real estate, okay? Or you can invest in stocks, bonds, mutual funds, whatever you want. Or you can invest in another business. Maybe you like karaoke bars. I don't know, right? You can start another business, incorporate that company. Your holdco could be a shareholder of that other active business company, okay? And any dividends paid up from the active co would also be tax-free as well. Now, of course, your holdco earning investment income through real estate or investments here, the tax rate is 50 and say 50.67%. But the benefit is if you have a holdco here, you only pay the 11% corporate tax rate on those funds. So the money coming up to your holdco is only taxed once. If you did not have a holdco where you're in a situation like this, in order for you to make that investment, you got to pay that money out to yourself first. And when you pay that money out to yourself first, you trigger personal income taxes, and then you make that investment with after-tax personal funds. That's not very tax efficient, okay? So with respect to real estate properties, just bear in mind that in a private corporate structure, different tax rates, personal tax return, no distinction in terms of the different types of income, okay? So it's not always a simple answer, should I own that property through a corporation or not? Doug's gonna hit off on things that you want to talk about, or do you want?
Well, you made a whole bunch more questions.
That often happens, right?
You don't want to even hear what I'm thinking.
Okay.
But I'm a property manager buying a property that wants to put a mortgage on it for myself. It's
Maybe we'll save that for another day.
yeah. Maybe a phone call.
That's billable hours right there.
Well, not for Doug, you know.
That's
Yeah, we got a great working relationship.
a conundrum.
So, ladies and gentlemen, thank you very much for your time today. I'll leave my phone number and email address up there. I do encourage you to reach out to me if you have any questions at all, not just about what we talked about today, but I really do want to serve as a resource for you too. So if you have a client who has a tax issue, maybe a GST issue, an income tax issue. I also do a lot of non-resident tax work as well. And in the downtown core, we have a lot of properties that are owned by non-residents of Canada. Please don't hesitate to reach out to me. I'd be happy to serve as a resource for you. And yeah, I don't bill for that either, right? I really don't. For me, it's just a service that I provide to you so that you can get the right answer at the right time for your clients, okay? And then if there's anything that's in there for me later on in terms of billable work, that's really aside from the point. But, you know, if there's an opportunity I can do some work for you, I would love to, okay? All right, thank you very much.
Yeah.
Thank you.
Yeah.
I'll stick around for a little while.
Hey, we're just gonna do one more thing. Paul, who's gonna come up, talk a little bit about mortgages, bank failures, interest rates are dropping like stones. Get out there, do some refinancing.
Maybe. Jimmy, fantastic presentation. Thank you. There's
Thank you.
nothing more sobering and eye-opening than a income tax presentation. So we learned a lot there.
Thank
I
you very
know
much.
I'm scared, so thank you. I didn't really have a presentation today. I just wanted to get up and say hello. I think I've met everybody here. If I haven't, let's get it going, get a coffee, lunch, whatever. So far, it's been great. Just want to do a quick update with markets. There might be some big changes this week. What's going on in the US? Bond market pretty much tanked yesterday as much as it did in 2008 in one day. So 5-year fixed rates tend to follow that. We might see some pretty good drops this week. So I'll give you updates as we see them. As an example, TD Bank yesterday, we had a client at 534. We called Treasury, they dropped it to So that was like kind of a one-day change. So we might see a lot more of that coming up, which is great. The lower fixed rates go based on a 2% stress test, the easier it is for your clients to get approved. So that's what we're hoping for, is somewhere in the low fours would be, I think, a healthy environment. Rates, bond market, we've covered it. Doug's talking about multiples. There's no inventory. There are a lot of clients. What's going on there?
Oh, sorry, I was shutting down. Didn't realize I was blinding you.
Okay,
Sorry.
now you're all docs. So multiple offers. Yeah, there's not a lot of inventory. We've got a lot of clients right now that are looking for pre-approvals. It's very, very busy. People aren't concerned about rates. If they can afford the payment, they're getting into the market, okay? Pre-approvals are abundant. Multiples will happen. I can't stress enough to have that pre-approval with whatever lender or mortgage broker or me or clients are working with.
Sorry, speak up a little.
Okay,
Yeah.
sorry. I thought I always yell, but okay. So multiple offers, pre-approvals. What you don't want to have happen is walk into a situation with your client where you're not prepared for financing, or you think your client can afford a property, and I get an application and they're nowhere near it. Okay, it's a lot of work and stress that you guys can avoid by doing that. And if there's any complications in the file, we've got time to get through that. Right? You all know in multiples, it's very hard to put in a subject financing clause. So the more we see up front, the easier I can make it for you guys to get the job done. So just prepare. That's all I have for today. You guys let me know. You have my information. If you have any questions, I'm here to help. I'm here to answer questions. Look forward to working with whoever needs the help. And we will all meet again soon and have a coffee, lunch, whatever we can. Hopefully some sort of thirsty Thursdays in the office.
Yeah, I think we're gonna reach it. Absolutely, yeah.
Yeah.
So we're arranging that.
That sounds like fun.
Everybody as well,
Oh,
Jimmy.
thank you.
So
Thanks,
everybody,
everybody.
Thirsty Thursday.
guys, make sure, thanks, Paul. Make sure you guys introduce yourself to Jimmy and Paul, of course, you know, but Jimmy as well. Get a card. He's handing them out. Reach out to him, like you say. He's open to collect questions from your clients. You know, when they're like I say, you're not experts. You're not lawyers. You're not accountants. You're not inspectors, and so on and so forth. So Jimmy's a good go-to guy for you guys to know. Nice to have a name to a face, and when you call that, you know who you're talking to. So, and he can help you with your taxes as well. So go with that. We have our awards. What's that awards coming up?
April 6th.
And you guys can win some of these here. The big hardware.
Oh,
This goes to Jimmy for best presentation. Thank you very much.
No way.
Yeah.
Really?
Go on, yeah. There you go. Jimmy, way to go. Everybody.
I'm kidding. Wow. There's
It's
geez.
one of our ones there, Jimmy. You're good.
That's hilarious.
But we are having our awards, so you know, you come out to that. When is that again?
April 6th.
April 6th, right? And
Yes.
and we're Mike was talking about. Mike couldn't be here today. He's in Whistler right now, having a great time skiing. We just got a foot of snow, so I'm sure they're really quite enjoying themselves. But we have that coming up. We're gonna have some social events, libations, you know, going out there Thursday or whatever it might be, going forward. And there's some Canadian games that we're trying to organize and such like that. There's one that I want to do is the Science World has a adults evening night. So you go there and play all the little games and whatever and have a drink. So we'll and that's close by. So we'll do a little bit of that, lots of stuff, anti-COVID stuff, getting out there and do some stuff when we got the chance. So that's it for this week, guys. Next week online, we'll see that. Yeah, go ahead.
There's a question about the two banks in the US collapsing will lead into the decrease. So there's a question here. Is it possible to explain why the two banks in the US collapsing will lead to decrease in fixed rates?
Paul can do that one.
Yeah.
How about you?
My
Put your
economy PhD will pay off here. No, that's not true. So basically, the uncertainty in the US financial system caused the bond yield market to tank yesterday for economic reasons that we can get into another time. But essentially, 5-year fixed rates in Canada follow that bond chart. And as they come down, Canadian banks price their mortgages based on that. So that's what's happened yesterday. It was a big drop, so we should expect, we haven't seen a lot yet, but we should expect rates to come down this week.
Okay.
Awesome. Yeah, lots of money going into the bonds right now. There's nobody's pulling them out and dumping in there, so lots of supply and demand. Our yields going down, so our expenses are going down for mortgages. Okay, that's it. We're good.
That's all that.
Guys, have a good week.